The venture capital industry in Q3 2025 was characterized by explosive growth in deals by dollar value, which drastically masked underlying fragility and capital concentration. The quarter cemented the notion that while global VC funding has rebounded from the post-2021 market correction, this capital is flowing into an increasingly narrow funnel of mega deals in the AI, deep tech, and infrastructure sectors. In this in-depth analysis of the venture capital industry for Q3 2025, we cover 7 trends. The first trend is the AI concentration reaching peak velocity. AI's dominance intensified in Q3, moving from merely the core of VC strategy in Q2 to an engine of unprecedented capital hyper-concentration. This phenomenon drove the entire quarter's funding rebound but introduced significant structural risk. Foundation AI and related infrastructure companies captured roughly 46% of global funding for the quarter, or approximately $45 billion. In North America, this share was even higher at nearly 57% of total VC dollars. For known AI software founders who are in SaaS and fintech, the cost of capital has effectively skyrocketed. To secure funding, they must credibly demonstrate how AI is the central economic or defensibility driver of their model, not just a feature. The vast majority of this capital was concentrated in just a few hands. The 3 largest global rounds, Anthropic $13 billion, xAI $5.3 billion, and Mistral AI of $2 billion, were all raised by foundation model companies. In total, only 18 companies raising mega deals accounted for nearly 1/3 of all global funding. This highlights the winner-take-most nature of the foundation model race. Investors believe only a few LLMs will survive, leading to a relentless capital war to ensure their chosen champion secures the required resources in chips, talent, and data to achieve an unassailable scale advantage. A new risk also emerged around circular investment deals. These involve chip manufacturers like NVIDIA or large corporate entities investing billions into AI startups like xAI or OpenAI, with the clear expectation that the capital will be immediately recycled back to the investors in the form of massive chip and compute infrastructure purchases. This structure may be necessary to accelerate AI infrastructure build-out, but it suggests a potential mispricing of risk. If the underlying AI models fail to generate sustainable revenue outside of their big tech ecosystem, these sky-high valuations could correct dramatically, taking out unsuspecting businesses and industries depending on AI. The second trend that we observe was the rise of IPOs and the rise of secondaries. The exit market, which showed a fragile rebound in Q2, achieved genuine momentum in Q3, driven by high-profile IPOs and a burgeoning secondary market. This provided the critical liquidity that LPs has been demanding. Global VC exit value saw a massive increase, generating $85.3 billion in exit value from 60 global listed companies. US IPOs of VC-backed companies generated $36.4 billion in exit value alone, a gain of over 300% year over year. The success of these IPOs is a critical market signal. It breaks the deadlock of the past 2 years, proving that public market investors are willing to pay for growth with strong fundamentals, unlocking a vast backlog of unicorn companies waiting to go public. The companies that successfully went public were highly selective, generally exhibiting stronger financial profile than those in the 2021 boom. Notable Q3 IPOs included Figma and Klarna, 2 names with a strong and loyal customer base. The market has officially shifted from rewarding growth at all costs to prioritizing the rule of 40, where the sum of annual revenue growth rate and profit margins, or EBITDA, should cross 40%. This new standard forces all remaining private unicorns to delay their IPO until they achieve demonstrable financial maturity. A key structural change in the IPO market was the increased role of secondary sales within the public offerings. A large portion of shares came from existing shareholders, including VCs and employees, rather than newly issued shares by the company. This trend confirmed that VC's primary goal was recycling capital back to LPs, with liquidity being a more immediate concern than holding for the long-term public return. The trend is a proactive measure by GPs to manage fund cycles. By selling a portion of their stake at IPO, funds ensure LPs receive distribution and can commit to the next fund generation, maintaining the health of the entire ecosystem's capital flow. The third trend that we observed was the Medtech investments shifting to differentiated late-stage innovation. The Medtech sector proved to be a relative safe harbor. VC investment in the sector surged by 20% to an estimated $8.7 billion for the quarter. Healthcare investment is de-risking. Medtech assets with clear regulatory approval pathways and predictable enterprise sales cycle are appealing alternatives to volatile early-stage consumer health apps or pure biotech plays with distant commercialization horizons. Average financing rounds swelled significantly to $37 million, a 122% increase over 2024. This reflects a market focus on acquiring later stage assets closer to profitability and with demonstrated clinical traction. The concentration signals that corporate M&A buyers, including pharma, large device makers, are driving deal terms. VC funds are essentially acting as sophisticated developmental capital, preparing companies for acquisitions by building robust late-stage revenue and regulatory moats. Investor confidence was concentrated in technologies driving differentiated innovation in key therapeutic areas, including robotics-assisted surgery, structural heart devices, and pulse field ablation or PFAs, often with strong AI integration. The highest value is found at the convergence of medtech and AI or robotics. These areas offer immediate demonstrable efficiency gains for hospitals and surgeons, justifying the high purchase price and thus the high evaluation multiples. The fourth trend that we observed was the robotics and industry automation going mega round. The hard tech pivot from quarter two accelerated with robotics and industrial automation moving into the mega round category, driven by labor shortages and the need for physical world AI applications. Robotics cemented its place as a key pillar of the hard tech theme, highlighted by the $1 billion Series C raised by Figure, a developer of general-purpose humanoid robots. This funding scale is required for hardware R&D and manufacturing capacity. The market is no longer investing in robotics software alone. It's investing in the complex engineering, supply chain, and deployment of fully embodied intelligence. The investment focus is specifically on AI-driven robotics and industrial automation. Notable rounds included a $120 million Series A for Dyna Robotics, which is the foundational model for robots, and a $290 million round for Divergent, which is into digital manufacturing. The VC industry sees industrial AI as immune to much of the macro volatility affecting consumer markets. These are direct bets on labor displacement and manufacturing efficiency, which is required for global industrial competitiveness. The fifth trend that we observed was the early stage funding crisis that has deepened under contraction. Beneath the flashy mega deals, the venture capital industry suffered, with capital becoming highly selective. The seed or angel funding stage saw a significant 25% sequential decline in capital to $4.6 billion in North America, with the number of early stage rounds also shrinking. This confirms that the preference for doubling down on existing proven portfolio winners came at the expense of funding new, unproven ventures. The bar for a check at Series A or B has moved to prioritize proven capital efficiency, clear revenue, and a path to profitability. Companies with early revenue streams attracted 55% more funding than those still in ideation stages, forcing founders to extend their runways and focus on core metrics over speculative growth. VCs are acting more like private equity at the early stage. They see companies with product market fit, validated by revenue and healthy unit economics, effectively shifting the risk of initial product development back onto the founders and non-institutional capital sources. The sixth trend that we observed was the high demand in the secondary market. The sustained lack of liquidity over the past 2 years, coupled with the Q3 IPO success, intensified the strategic demand for the secondary market as a portfolio management tool. Demand for secondary shares increased, with bids climbing to 40% of total observed volume in Q3. This was fueled by LPs and some GPs seeking to rebalance portfolios and realize paper gains after the successful IPOs. LPs are actively using secondaries to manage vintage risk. They are selling older, slower-moving assets to free up capital to meet new capital calls for the high-performing mega funds, accelerating the portfolio concentration seen in primary markets. While overall secondary market returns improved, volatility in the most sought-after AI sector assets intensified significantly, climbing from 56.7% in Q2 to 292% in Q3. This trend reflects extreme market disagreement on the valuation of these critical but volatile private companies, including Anthropic and OpenAI. The AI valuation bubble is testing the limits of secondary buyers. The massive volatility suggests that while the hype is intense, there is no reliable consensus on what these companies are truly worth outside of their specific recent mega rounds. The slowdown was concentrated at the lower end of institutional activity, while bid volumes increased throughout the quarter, signaling that LPs are executing larger strategic secondary transactions rather than small routine sales. The seventh trend that we observed was the investment in defense, space, and industrial over consumer technology. Q3 saw VC funds fully embrace the strategy of funding companies tied to government, infrastructure, and national security objectives, a stark contrast to the consumer-centric ethos of the last decade. Beyond core AI, investment flowed heavily into sectors where technology has both civilian and military applications. This provided startups with two highly stable customer bases: commercial enterprises and government agencies. Venture capital is entering the sovereign tech era. Geopolitical instability drives government spending on advanced technology, creating massive, non-cyclical, guaranteed revenue streams that are highly attractive to risk-averse VCs. VC funds are prioritizing deep moats over network effects. Building physical compute centers or manufacturing complex robotics offers inherent, unassailable defenses against competition. Unlike the easily replicated digital tools of the previous cycle, VCs are selecting companies with high regulatory moats and deep intellectual property, which are generally associated with defense, space, and health tech, over easily replicable consumer software models. There is a fundamental long-term shift in the perceived risk and return profile for new venture capital investment. Durability is the new growth. The focus is on technologies that will define for the next 20 years, not just apps for the next 2 years. For industry trends, salary trends of M7 and Top 20 MBA, and in-depth curricular analysis, along with exclusive admission advice for your MBA and master's application, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe.